We're here to talk about Silicon Valley real estate market geographically, and then the Greater Bay Area. This is week number 13th, March 30th. These URLs we'll get back to at the end. Here's a recap of what we're going to be going over. These are the 20 micro market areas of Silicon Valley. Then we look at three components. We look at the active inventory, we look at the offers accepted, and the days of unsold inventory today compared to the 10-year median. We then move on and just look at the raw count of days of unsold inventory. Then we go on to days on market. This is simply the 75th percentile of the sellers. Now, the sellers that are successful, how long does it take 3 out of 4 to sell? This is that time frame. Then we look at the sellers adjusting their ask price, the magnitude of it, followed by the frequency. Then we flip over and look at what the buyers do, the magnitude and frequency of their overbidding. Then we look at appreciation since 2015, and then we look at the sold price, not just the median, but the 10 and 90 percentile. So you have a sandwich in each area, and then I have a calculation over here for the payment, assuming it's 80% jumbo loan, 30-year fixed. So here's the first data slide. We're looking at the active inventory compared to their 10-year median. You can see most of Santa Clara County is short on inventory, maybe around 65%. You get up into San Mateo County, and it's 75 to 100%. In Alameda County, I just have county-wide data, and it's sitting at 72%. And the reason everything is red in color is the lack of inventory. Less inventory than you expect favors the seller. There's less competition, therefore it's more aggressive. But now we flip over and simply look at the other side. What are the buyers doing? And you can see in Santa Clara County, you're somewhere around 80% for most of it. You got 58% down in South County and 70%, but a couple at 80s, and then you got a couple at 100. You move up into San Mateo County, and it's all over the place. You go from 57% to 120%. So Redwood City right now has more offers by 20% than they typically do. But most of the county is about 90% of the inventory or the offers accepted that you'd expect. Going over into Alameda County, they're at 76%. And again, that's county-wide data. They're losing about 25% or a quarter of the market compared to the number of offers they typically get. Then we look at days on sold inventory. So now days on sold inventory is the speed of the market, the balance of the marketplace. And this is comparing the balance to where it is. You can see the affordable areas, South County and East Central South San Jose, are all right at 100%. The rest of the valley is somewhere right around 70%, or Santa Clara County is around 70%. The speed of the market is a little faster, 30% faster than it typically is. You go up into San Mateo County and you're at 182% on the coast, which is blue, because that's almost twice as slow as it typically is. Then you have the expensive areas, which are white in color, because it's right about 100%, as well as the Bay Cities in San Francisco and North San Mateo County. The only area that is faster than normal is Redwood City, and it's likely because you have limited inventory and the extra buyers. And then if you go over into Alameda County, you're right about 90%, 86%, 87% of the speed that you normally have. So only about 10% faster. Basically, what we have is we have a shortage of active listings, but we also have a shortage of buyers, which keeps the marketplace roughly about the speed it typically is at this time of the year, and maybe a little bit more aggressive than it typically is, a little faster. Now we're ignoring history and just looking at what the values of days of unsold inventory are today. And the reason days of unsold inventory is so important is this measure of supply and demand balance. And you can see most of Santa Clara County is right around 2 weeks. Yes, South County is at 40 days, almost 6 weeks. You jump up into San Mateo County and you got the expensive areas at 70 days or 10 weeks, and the coast at 11 weeks. So clearly a much slower marketplace there, but still what I would call a balanced marketplace. But then the rest of San Mateo County is at under 3 weeks, at 18 days, roughly 12 days in Redwood City, probably one of the fastest in the area. Then you go into Alameda County and you've got Dublin at 14. You come down to San Leandro at 58 days, Oakland at 49 days. Basically anything from 6 to 11 weeks I consider to be a balanced marketplace. Over 11 weeks is a buyer's marketplace, and under 6 weeks is a strong seller's marketplace. Now, here's the time on the marketplace. So this is simply looking at the time on the market for the successful sellers, and this is 3 out of 4 sellers are selling this amount of time or less. If you start off in Santa Clara County, you can see that basically the entire county is selling in 2 weeks or less, which is pretty incredible when you think about it. But then you go up into San Mateo County, and even your slower areas are selling in 4 and 3 weeks. The bulk of San Mateo County is selling in 2 weeks. And you go over into Alameda County and you're selling in 1 week in some of the areas and then 2 weeks in the others. Basically a pretty aggressive marketplace. You go anywhere else in the country, and if you told the sellers that 75% of you would be successful in selling in 2-3 weeks, they would think that'd be pretty darn good. We're still looking at current conditions because this is looking at sellers' ask price reductions. And the vast majority of the sellers do their homework before they put the house on the marketplace, and therefore they don't have to adjust their price. Also, when the market is moving and 3/4 of the homes are selling in under 3 weeks, they don't even have time to adjust their price. But this is on average. You look at the sellers that are reducing their price and you look at the sellers that are increasing their price, and yes, sellers increase their price. Usually it's not while the house is on the market, but they increase it, then a day or two later they report the sale so that the sale price is closer in line with the list price. But you see a good part of Santa Clara County is above their original ask price. So they come on the market at $1 million, they raise it to 1.1 million because they got an offer at 1.2. The areas that are seeing a decrease are San Mateo County Coast and Redwood City. And that's almost bizarre that Redwood City is having a 2% price reduction when it's one of the more aggressive areas. And I think what was going on was just a few weeks ago, Redwood City was pretty slow. So I think now the sellers have adjusted their prices downward and the buyers are coming in. And these are not sellers increasing their price 1% and decreasing at 2%. This is the vast majority of the sellers not making any changes at all. And the ones that are making changes are making changes in the order of 5 and 10 and 15% and sometimes more. Now you're looking at the frequency of those adjustments, and you can see in Santa Clara County, you're basically 5% or less in most of the valley of the sellers are doing price reductions. So that means 19 out of 20 sellers make no price adjustment at all. You go up to San Mateo County, and Redwood City's at 8%, the coast is 15%. And that's sort of interesting. The coast is really slow, but still only 1 in 7 sellers is adjusting their price downward, well, adjusting it either direction. I don't think it's limited downward. You go over into Alameda County and it's much lower. It's much more like Santa Clara County, where most of the area is less than 5%. The real stick out exception there is Oakland, where 16-17% of the sellers are reducing their price. Now we delay because in order to get the magnitude of the buyer's overbid, we need to know what the buyer's price was, which means we have to wait for escrow to close, which delays the data by 4 to 5 weeks. But in Santa Clara County, you can see a lot of the areas at 10%. The coast, the buyers are going in on average 1% below. Redwood City's coming in at 9% above, along with Foster City. But the Bay Cities is at 6%. You go up into Alameda County, and you go from 4% in Pleasanton to 13% in Berkeley, 12% in Fremont. So you can see that each micro market area is significantly different. Yes, there is a difference between paying 13% above a seller's asking price and paying 3% above a seller's asking price. You have to understand, what the micro market is that you're working in, as well as what, is the listing you're interested in at transparent pricing, or is it teaser pricing where it's going to go up 20 or 30%? Statistics don't help you on any particular transaction. It helps you understand what's going on in that particular area. Here's the frequency of overbidding, and you can see in Santa Clara County, 8 out of 10 sellers are getting more than their asking price in the bulk of the affordable areas. The more expensive areas, it's 7 out of 10. And in the real affordable areas, it's 6 out of 10 are getting more than their asking price. San Mateo County, you can see only 30% overbid on the coast, which is actually into the buyer's marketplace. Once it's below more than 1 in 3, I'd say that's a buyer's favored marketplace. That says something right there. Just 1 in 3 sellers are still getting an overbid, and I consider that to be a buyer's marketplace. Atherton at 40%, but Bay Cities and Redwood City is sitting at 65% roughly. Foster City, 88%. North San Mateo County, 66%. Oakland, Alameda County, you can see is basically 85% more or less. Oakland, again, is the exception in that area. Now we're looking at history. We're looking at long-term appreciation since the last 9 months of 2015. Here, the red color is the most appreciation. The blue is the least. So it's not favoring the buyer or the seller, but great appreciation is something sellers would like. In Milpitas, North Valley, you've had more than 100% appreciation. So you've doubled your money. And if you were buying a house with 20% down, you've leveraged it 5-to-1. So you've now actually made a 500% return on your money in basically 10 years in Milpitas and Berryessa, Santa Teresa. Pleasanton, I think, is the high out of all 20 micro market areas at 120%. And again, if you put 20% down, you're making a 600% return on your money in the 10 years. Now, instead of following just the median price, which is the middle column, I look at the cheapest 10% and the most expensive 10%, so it's sandwiched. And let's jump down to like Cupertino. The cheapest single family home you can really expect to buy in Cupertino is $2 million. The typical home is almost 2.8, so there's an $800,000 price increase. And then the most expensive 10% home, the 90 percentile home, is 3.8 roughly, goes up $1 million. And that's fairly consistent where the price increase from the first cheapest 10% to the median 10% is less than from the median to the top. And that's just because the distribution, it's more densely populated. So you can come down and look at the different price ranges, and it gives you a range. Because if you're limited to $1 million and you want a single family home, you quickly see that Dublin, Livermore, Castro Valley is one of the few areas, along with San Leandro, Hayward, Oakland, Alameda, Berkeley, that you can buy. And then in Santa Clara County, South County, and East San Jose, otherwise you're from $1 million to almost $3 million for the cheapest single family homes. Now we're going away from the micro market data, and we're looking at Silicon Valley as a whole. So it's all 20 of those micro market areas in a blender. We're looking at the three components. So you can see inventory drop down fairly significantly this last week. Why is that? It's this weekend. Friday was Good Friday. Sunday is Easter. Monday is Cesar Chavez holiday. Every holiday negatively impacts the real estate marketplace. Now you have three not huge holidays like Christmas and New Year's and Thanksgiving, but still three holidays that combine, and you see the drop in inventory. Then you move on and you look at offers. Well, the buyers are making their offers this past week on last weekend's inventory, so it actually went up. And because these are basically acting in opposite directions, both of which accelerate the marketplace, the speed of the marketplace, days of unsold inventory, went drastically down or faster from 90% of where it typically is to something like 75% of where it typically is. So we went from 10% faster to 25% faster. Here is my concern graph that looks a lot better this week of the limited inventory. We're no longer a record low. We're only the second worst year. 2020 was worse than it was this year. Why is that? But in 2020, we had the pandemic announcement on about the 15th of March. So now on the 29th of March, and yes, we're on the 30th, but the data is only through the 29th. I gathered it on the 29th. It's actually through midnight on the 28th. The data is in 2020, the shelter in place order was starting to impact the market. So 2020 was the worst year, and we're only 100 units more than in 2020. And I still think that's significant. Now looking at the estimated payments, this is the cheapest home. So out of that whole Silicon Valley, where are we? And you can see the dip down, and now you're back up here at somewhere around $7,000 a month payment. And you come up here into the typical home, and that's $13,000 a month payment. And you come up here to the most expensive, and you're at $27,000. Again, this is all assuming an 80% loan. Usually, if someone's buying the most expensive home, they've sold a home or they did well in the stock market or some other investment, and they're not doing an 80% loan. I don't know of anybody that has a $27,000 mortgage payment, and I think the number of people that have that kind of mortgage payment is probably pretty slim. Now we're looking at the price distribution of ask price reductions. So the blue dotted line here that's bold was where we were a year ago. The green dotted line is where we are this year. You can see that we're quite a bit more improved this year than we were last year. The other thing, though, notice the number of solid lines here, they're starting to cluster. The amount of seller price reductions has sort of picked out, which would suggest that right now we're close to the most aggressive part of the marketplace, and now we're going to start getting flooded with inventory. And May typically is the month with the most number of transactions, and then we go into our summer correction. But anyway, here we'll step through. That's a year ago roughly, and then you can see that was a year ago. Now you're starting to go into fall. That's sort of the bottom last fall. There's your increase 9 weeks ago. Now you can see that the increase is getting less, and now it's almost gone away and it's bouncing. And now we're this week versus last year. We're clearly significantly better than last year, but I think we're already basically at the peak. In other words, sellers were coming on the market a week ago or 2 weeks ago, 3 weeks ago, 9 weeks ago, and they were underestimating the marketplace. They're now no longer underestimating the marketplace by a greater and greater amount. They're starting to understand the market has taken off, and that stabilizes the marketplace. Now we're flipping over and looking at what the buyers are doing. And again, this data, because it relies on the sold price, is lagging behind by 4 to 5 weeks. The blue dash dotted line down here is where we were a year ago. The green dash dotted line is up here. That's where we are now. So you can see the market is significantly better than we were exactly 1 year ago. There we were, and you're improving last year. Then you're starting to have the summer slowdown, and then you get into the fall. There's 10 weeks ago, and now you're starting to improve 6 weeks ago. And this is still going to improve a little bit because of the lag time, but for whatever reason, the overbidding is a little bit more stable and doesn't change as much as the frequency and magnitude of ask price reductions. And this is the distribution, as I was saying. So you look every week, you go back in time 5 weeks and plot in this case, the amount of overbidding. What this tells you over here is 5% of the sellers were getting 30% above their asking price, and 5% of the sellers were getting about 6-7% below their asking price, because you subtract off 100. Half the sellers are right here at 108% or something like that. Now we're going to look at the active inventory, the component, the metric, and the red line on all the following graphs is the hot marketplace. The blue line is the cool marketplace, and the gray line is the typical. So you can first off see the seasonal cycle. The other thing I want to point out is starting on January 1st, 2023, this x-axis is more spread out, so you can see the detail. And then from 2023 back in time is more compressed, so you can get a 10-year track record on here in one graph. So you can see the cycle happens every year. Then you get into 2023 and it's blown out. So you have a full 1 year cycle here, and then you can plot the current data. We're basically, as far as inventory, we dropped down from last week and we're approaching a hot marketplace. I expect this will go up fairly significantly next week because we're past the holidays. Now we're looking at that gray line stretched out in a straight line, and we're looking at a percent of normal. So you're down here at 72% of normal. That's a lack of active inventory that favors the seller, and therefore it's shaded red in color. Now we move on to the next metric. Same thing on buyers. You can see that earlier this year, we were actually below the blue line. Right now, this week, we've crossed over and we're above the blue line for the first time. Next week, we may turn around and drop back down, because next week is the data that's going to impact this holiday weekend. There's no new real inventory came on the marketplace, and the buyers are busy with social events. Monday's a holiday. Some people are out of town. We're going to have less buyer activity, which is going to cause the market to go slow down, less offers accepted. Same concept, you stretch out the gray line in a nice straight line. We're only at about 82% of where you'd expect the number of offers to be. So we're missing 18%, almost 20% of the marketplace. So that favors the buyers. Now the key is days on unsold inventory. Where does it go? Well, this week we didn't have new inventory. We had a lot of offers from last week. So your days on unsold inventory decreased, which is an increasing hot marketplace, which is why we went down here. And we're roughly halfway between a typical marketplace and a hot marketplace. And the next line is we stretch that gray line out, and you can see the huge improvement. We went from 90% down to about 76, 75% of the market. So we improved almost 15% overnight because of the two impacts. The impact is you had a lot of inventory from last weekend, and this weekend you have no inventory, and that causes the DUI to go up. Here you're looking at that days on marketplace, and this is the reason I look at the 75th percentile. You've had 3 weeks in a row now with the same value, and if you follow the median price like a lot of people would, it would be more stepping like that. I like this normal progression where you can see changes in the marketplace. Here, once you get below about 15 days, you start getting these step functions because there's not enough days to spread the data out. But you can still see that you're on the hot side of the gray typical line. You're almost at the hottest you'd expect the market to be. And we're sitting here at 15 days. So that means that in all Silicon Valley, 75% of the sellers are successful in selling their home in that 15 days. Here's where we compare to typical. So gray line stretched out, and you're down here at about 79% of normal. So the market's actually faster. Sellers are selling quicker than they typically do. Here are the sellers' ask price reductions. Here, the ask price reductions are on the cool side of typical. So sellers are still taking a greater or percent of their ask price reduction, but this is a very tight metric. We rarely go over 100%. When you look at the whole valley, it's rare that the sellers on a whole have gone up above their asking price. You're typically right now at this time of the year right here, which is only about a 0.25% price reduction. And in a cool marketplace, you're down here at a 0.75% price reduction. So there's not much fluctuation, but you are on the blue side, the cool side of typical. And here you stretch that out. And here, you know, it does, I would have thought it would have been down more, but, you know, the computer does the number crunching for me. You're at about 99.9 something percent probably, because here's 99. So 2, 4, 6, 8, that's 99.8. You're more than halfway. So you're 99.7, maybe 99.6, something like that. So only a quarter of a point reduction. This is the largest 10% of the sellers that are doing the price reductions. I talked about most sellers don't have time to do a price reduction. So instead of looking at the median or the 75th percentile, I go out and I look at the extreme. And that's why in a hot marketplace at this time of the year, you're right here at the first, second quarter borderline on basically April the 1st. You're up here and the seller is doing like a 94.5%. So there would be what would that be? It would be a 4.5% price reduction in a hot marketplace because you're only looking at the 10% of the sellers that are taking the biggest price reduction. Typically, you'd be about a 7% price reduction. Right now, you're at about a 9% price reduction. And in a cool marketplace, you'd be down here at about a 10.5% price reduction. Tight metric. I'm looking at the extreme to get an idea because I believe looking at this eliminates that 4 or 5 week time frame to look at close price. Here is the data stretched out, and so now you're taking slightly higher, or somewhere around 25% more price reductions than you would expect. Here's the frequency. Now the frequency of price reductions is right on top of the gray line, so you can see you're having a typical marketplace as far as the number, and here it is right on normal, slightly above, but not much above. Here's your average overbid. So overbidding now is on the hot side. Buyers are overbidding, and that's been that way for quite a while now, almost a year, 3/4 of a year, starting at the beginning of third quarter last year, all the way through first quarter of this year. You've been above the gray line. We changed over now to overbidding. So overbidding was above, and it's above on that, which is what you'd expect it to be. And this is lagging data. So the fact that this is going up right at this time doesn't surprise me, because this data requires the sold price, and sold price takes 4 to 5 weeks to get out. And here's the frequency of overbidding. The frequency of overbidding is above where you'd expect it to be by a bit, because it's the vertical line, not the horizontal separation. And here you can see that you're above the typical marketplace, the gray horizontal line. Here is your long-term appreciation. The big takeaway is that I like to stress to people is look at the dip down at every year mark. Yes, in 2022, the market was pretty flat, but if you remember, the market was absolutely on fire at the end of 2021 into the first 45 days of 2022. So the typical downturn got turned into a flat, but down in a U, down in a V, down in a V, down in a delayed V, down in a V, down in a V, down in a V, down in a V. It's so consistent. I believe it's based on the social obligations of the potential buyers at the end of the year, and real estate's an optional event, so they go bye-bye. And then that's why we have the run up first quarter. Look at this. You went from basically some number not far above 1.4, and now you're almost to 1.7. We've gone up almost 20% in just one quarter, which is just unbelievable. Now, that's not, in my opinion, that's not property values. Yes, it's the median price, but I believe the mix of the home has actually changed, so you're not comparing apples and apples. Now we're coming back and looking at Silicon Valley at the three counties to show you that they're not all the same. This is simply the active inventory. You got to be a little careful. San Mateo County is almost always going to be on the bottom because it's the smallest county. Alameda is typically the biggest county, but the takeaway is where the levels are now compared to where they are first quarter now, roughly the same as first quarter of last year and potentially even first quarter for the last several years. But before the pandemic, look at the levels at first quarter. You were somewhere around 1,200 for Alameda County, somewhere around 800 for Santa Clara County, and now they're both below 600. That's huge. Here's the offers accepted. And the offers accepted are starting to come back fairly abruptly, like they typically do at this time of the year. You can see on the condensed scale and how vertical that is. This scale should be half the slope, and it's almost the same steepness. So that's really telling you the market's gone up dramatically as far as the number of offers accepted. Here's your days on sold inventory, and because offers are going up, the days on sold inventory are dropping. The speed of the market is accelerating, so it's going faster and faster. Here's the time on the marketplace, that 75th percentile. You can see Santa Clara County is faster at 11 days, where Alameda County and San Mateo County are roughly identical at 15 days. So Santa Clara County is selling 4 days faster. That may not sound like a lot, but when you start getting 15 to 11 days, that is pretty significant difference. Now you're looking at the magnitude of this price reductions. Sellers are taking a 1% price reduction in San Mateo County. They're taking somewhere around 0.3% price reduction. And in Santa Clara County, they're right at 100%. Again, it's real important to see the differences. And this is on the county level. So, we started off looking at the micro market areas, then we looked at the whole Silicon Valley. Now we're coming back and looking at the county level. Here's the ask price reductions, the frequency. You can see sellers in Santa Clara County are doing the least, followed by San Mateo County, and Alameda County is actually doing the most seller for price reductions, which is going to be surprising when you come over and look at overbidding, because they have the highest overbidding. You would not expect the highest overbidding to be occurring in the county that has the most price reductions. Usually sellers reduce the price when they're not able to sell. If they're not able to sell, buyers typically aren't overbidding. So it's sort of, one of the reasons you want to look at so many metrics. Then you have Santa Clara County at somewhere around 8.5% above the ask price, and San Mateo County is somewhere around 5% above the ask price. This is the frequency of overbidding. 60% of the sellers are getting over their ask price in San Mateo County, and in Santa Clara County and Alameda County, it's right around 76% of the sellers are getting more than their asking price. Here is the appreciation since 2015. Look at Alameda County. It was down here at about 147% maybe just at the beginning part of the year, and now it's gone up to 190%. It's the most dramatic increase. San Mateo County has done almost as well, but it started at a slightly earlier time frame going up, and it's really lagged behind recently. It's almost a 10% difference now in the appreciation. And Santa Clara County has the most appreciation, but has the least steep appreciation in this quarter, and just eyeballing it. Here's your median sold price. So now this is on log paper. Look at San Mateo County shooting up. Look at Alameda County shooting up. And even though normally I would think that's a pretty good increase for Santa Clara County compared to the other two counties, it's much more stable as far as the sold price. Here's on regular paper for those that prefer. Here's those estimated payments, and they're going to be in the same order because I go through the formula of PITI on an 80% loan. Here is your data for each county, Santa Clara, San Mateo, and Alameda County, or Silicon Valley as a whole. You can see the number of new listings are basically even from last week. I'm actually a little bit surprised it wasn't a little bit lower, but remember you're talking about this past week replacing 6 weeks ago. So 6 weeks ago, we were back very close to the Super Bowl. And so it isn't all that surprising that it stayed roughly the same. I expect it to go up again next week. Now we're leaving the Silicon Valley and we're going to be looking at the Greater Bay Area, which is made up of 5 regions. Here, starting off on the data, so you can pick the county, the region for Silicon Valley, or individual counties for everywhere else, but I did put in the 9 Bay Area because the media talks about it so much. And then I enter in Central Valley and Central Coast. Here is your inventory for the 5 regions, and you can see they're all down from where the historical levels are, and that decrease happened associated with the pandemic. The pandemic was coming back here, and then you basically ate up the inventory over time, and it just hasn't come back. Here's the offers. All the offers are shooting up. To me, it looks like Central Coast and the cities is going up less than the other 3 regions, which would be Silicon Valley in the purple, Central Valley in the yellow, and North Bay in the gray. Here is the days of unsold inventory. Silicon Valley is doing the best at about 22. That looks like about 25 days. And the slowest is the Central Coast at about 47 days, I would guess. Here's days on market for real simple numbers. Silicon Valley is at 15 days. And again, you're starting to see once you hit 15 days, you start getting these square jumps, which you don't like to see when you're doing statistical analysis, but it's there. And I think that's still a good benchmark. Then you have the cities, then you have the Central Valley, then you have North Bay, and the Central Coast is the slowest, the longest time on the marketplace. Here's sellers' ask price reductions. Silicon Valley is doing the least. Central Coast is doing the most. Frequency of price reductions, the sellers in Silicon Valley are doing the least, followed by the cities. And then you have a 3-way tie for Central Valley, Central Coast, and North Bay all together. Here is the overbidding. Here, Silicon Valley and the cities are basically tied. And it's a little surprising for me to see the cities up there, but they're at 8% over ask price. Then you have North Bay at 2%. Central Valley is at about 2/3 of 1%, and Central Coast is about 0.5% overbidding. Here's the frequency of overbidding. Central Coast is the least at about 37%. Then you have Central Valley right at 50%, North Bay at 54%, cities at about 62%, and Silicon Valley at 73% of the sellers are getting over their ask price. Here's the total appreciation, and you can see the cities is doing the worst. It's coming up a good clip. All the regions are going up pretty good clip. Silicon Valley is here and might be the strongest, but Central Valley is probably close to the weakest, but that's only because I think it takes longer for the waves to get out there, and buyers in the Central Valley are more price conscious, and that's why they're going there, is they can't afford Silicon Valley for the most part. Here's those price, and this is on regular paper. You can see the cities is the most expensive region, followed by the Silicon Valley very close. There used to be quite a bit more difference, and that's because San Francisco has done very poorly since the pandemic was announced. Central Coast is going along pretty flat as well. Then you have North Bay and the Central Valley. So the Central Valley is by far the most affordable area. Here's your PITI, and because it was the most affordable, it's got the lowest payments of just over $4,000 a month. That would be about $4,300, about $6,200 for the North Bay. Central Coast is maybe around $7,500, and then you have Silicon Valley at about $12,700, and then this is about $13,400 for the San Francisco Marin. We've been talking about Silicon Valley real estate market geographically, plus the Greater Bay Area. This has been week number 13. March 30th. If you want to get an archive of my YouTubes, you can either type in the blue YouTube archive at Silicon Valley Real Estate Data, or the shorter tiny URL as VREMG, which is what I call my root URL. If you want to join the presentation live Saturday morning at 9, add in 2024. If you want the handout, you put in H for handout 2024 0330. It is up. I got it up about 8:20 this morning. And if you want to go to direct to any specific episode, I'm Richard Calhoun with Creekside Realty, working with buyers and sellers here in Silicon Valley since 1981. Happy to discuss your real estate needs. Does anyone have any questions for me? Not seeing any unmuted mics. Have a great week. Take care. Bye for now.
Thanks, Richard.